Hello, everyone. This is Mike Wilkerson, founder of Stormwall Advisors. This is the Stormwall Advisors monthly update for February 2023. Each month, we take a look at something that's going on in the economy, in the markets, in the world around us, share some of our thoughts, and hopefully provide information that's helpful to you. You can learn more about me and about Stormwall Advisors at stormwalladvisors.com. I'm going to pull up a screen here so that you can see as we're going through what I'm talking about. Today I want to talk about inflation, and in particular about electricity inflation, power inflation, some of the dynamics that we're seeing going on in the markets. So first of all, where are we? So by year end, we see that inflation has started to come down to 6.5 in December from the June peak of 9.1. It's good news, but it's still too high. I think the important thing to remember here are the base effects, the fact that we've had multiple years now of running inflation on a compound basis. It's about 14-15% inflation at the CPI level over the 2 years. 6.5, better than 9.1 in June, but still well above the Fed's target of 2 to 3 points. I want to talk a little bit about an aspect of CPI that is perhaps being missed a bit, which is 6.5 was a better number than expected, but it's masking some of the things that are actually going on underneath. In particular, electricity has been one of the hottest running items of CPI over the last year. We have had since December of 2021 an increase on average of 16%. It's been much worse than that in the Northeast, where it's been running at nearly 23%. So this is really a significant issue with electricity inflation running essentially at 2.5 times the nominal CPI. Also, I think it's worthwhile to point out rising prices for electricity are actually driving inflation. So this increase in costs is pushing up prices of a lot of other things: food, production, any manufacturing, etc. In fact, look at what's happened since the pandemic. So since the end of 2019, prices are up by roughly 25%, a little bit less for some markets, commercial market, a little bit more for residential and industrial. That by itself goes a long way to explain the rise in prices overall. What's driving that? Well, you see, we've had the fuel stock for electricity in this country, just as they're in around the world, has also been rising. So natural gas prices spiked considerably in 2022. There are a lot of factors here, including the conflict in Russia and Ukraine, with Russia. Those prices have started to come back down as we enter into 2023, but still a real issue. Similarly, coal prices are up, have tripled since 2020. Those prices still remain elevated. So this is likely to continue to pressure prices into next year. Underlying that, apart from the fuel costs themselves, are the decrepit state or the decrepit state of the U.S. Energy grid, the infrastructure itself, where, first of all, it's very old. 70% of our transformers and transmission lines are over 30 years old. Our plants, on average, are 40 years old. And we have had the highest number of service failures in terms of blackouts per minute per customer of any of 9 developed nations in the survey, costing the U.S. an average of $150 billion a year. So it's fuel prices, but it's also the fact that we need to be investing in real infrastructure. Now, the not as good news here compared to the lower CPI number at the end of the year is that the electricity inflation is likely to continue. It is going to continue. We should expect more pain in 2023. Part of the reason for that is the lag in actual price movement from the power companies, many of whom are regulated and have to go through a process in order to be able to raise prices. But we see it's coming in 2023. Anywhere from 10% for Florida Power and Light, PG&E in California 18%, Georgia 15%, Duke Energy 20%. And by the way, we're reasonably well off compared to other places around the world. European electricity prices have spiked. Japan is raising their prices by 30% next year. Kenya Power up an amazing 40% in that region as well. if you look at what's happening around the world, in spite of this the change in the US, it's actually much, much worse in Europe, where we've seen prices go up by 3, 4, 5 times, depending on the country. This is comparing the 2 years through October 2022. It's easy to say that this is the war, this is Ukraine, Russia, etc. True, and these prices were already on the rise long before. In 2021, saw a significant increase in prices across the region as their fuel stock, as they make an aggressive transition to green energy, are actually hurting themselves and their economies by hamstringing their traditional sources of fuel, whether it was nuclear in France or coal in Germany. Clean coal was actually very technologically advanced. You look at this and you see what's happening. This chart represents the electricity price by country. This is earlier in 2022, so these numbers will have gone up, certainly for the Western European markets. But what you see a clear trend here is that those countries, especially in Europe, that have aggressively pursued a green transformation to zero carbon, are at the same time substantially hurting their economies and worsening the geopolitical situation as a result of high prices that are hurting their people. The US sits right here in the middle at 16 cents per kilowatt hour. But what's interesting to note here is that those in this new political alliance led by China, by Russia, by the BRIC nations, who are not as all sails to the wind on green energy, are have much lower electricity costs, which of course benefits their people, benefits their economy, and I argue puts the West at a pretty significant disadvantage. You look at China, its costs are half of those in the US, other places around the world, similar numbers. This is something that Europe has to focus on, something that the US has to focus on, rebuilding and restoring competitive strength in traditional energies. So how do we fix it? What can we do about it? And these lessons are really targeted towards the US, so that you can generalize around the world. But the first point I would say is, while fuel prices may be coming down, we don't know for how long. And in fact, it could be that as the energy crisis continues, especially in Europe in 2023, that we're going to have to be more thoughtful about long-term supply. So first point, increase the storage infrastructure to balance supply, rebuild the strategic petroleum reserves. Not exactly the same thing, but the idea is anywhere in the energy complex where it's possible to store natural gas or otherwise, we need to try to narrow the gap on these supply-demand mismatches. Secondly, as a policy perspective, the U.S. needs to encourage diversity of supply across all fuel sources, whether it's natural gas, coal, hydro, nuclear, geothermal, solar, etc., really based on specific local resources, what works in what market, in what region. There's not a one-size-fits-all solution here. You have to look at it across geography and resources. And these decisions should be made based on economic benefit, development potential, and not ideology. Number three, I touched on this, but we really do need to reinvest in rebuilding the U.S. electrical grid. It's been very disappointing to see how much of these so-called infrastructure spending bills by the federal government is rarely that. There's way too much spent on entitlements and pork rather than actual infrastructure, actual brick and mortar of building and replenishing, restoring, rehabilitating aging, decrepit facilities. Finally, or not finally, but number four, we must reform and restructure the regulatory system, which has become ossified, overgrown with red tape, and is hindering growth and project financing. This is an important point that has to be addressed. I think we're going backwards on this issue at this moment in time. Provide training and financial incentives for energy innovation, entrepreneurship. And finally, we have to confront dangerous ESG policies that throw out the baby with the bathwater, that restrict investment in traditional energy sources, that even if they're modern, they're clean, they're low carbon, not nearly as dirty as what's going on in India or China, yet we still can't seem to get project financing done. Banks are unwilling or unable to lend to legitimate projects. This is hurting America today. It's hurting Europe today. This has to be confronted, has to be stopped. We need to be able to invest in sustainable resources that we have based on our strength. The U.S. has the greatest natural resources in the world. We need to be able to use them across the entire energy complex. We will migrate in time when the technology allows us to a greener and greener future. In the meantime, we can't give up our main strategic advantage here, geostrategic advantage around the world. You can read more about these points at stormwall.com. Just put out an article called Double-Digit Rise in Electricity Prices to Continue 2023, hitting on the theme. Check it out there. And you can always learn more about me at stormwall.com or Stormwall Advisors at stormwalladvisors.com. So I want to thank you. If you've seen this on YouTube, please like it, share it, subscribe to my YouTube channel, and reach out to us at stormwalladvisors.com if any of this information is helpful. You'd like a PDF or other copies, or a further conversation on where these issues are taking your business or field of responsibility. Thanks, everyone, and we'll see you next time.